Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, and we are coming to you live at 5 p.m. Eastern, as we typically do on a Wednesday. It's December 3rd, 2025, and man, we've had quite the couple weeks here in the market after a big pullback, and now it's a big question of what's next for this market as we finish the year 2025 out. And to help us plow through it is Simon Erickson returning to the show. He, of course, is the founder and CEO of Seven Investing. Welcome back, Simon. How you doing?
Justin, man, it's great to be here. Always one of my favorite shows of the year. I appreciate you having me back on again.
Great to have you. I mean, gosh, we just had a little reconnect, pre-show and stuff, catching up on the family and fun and frolic and everything like that. I'm a little tan from my Kauai trip, so I'm not sure if you'll do the same thing when you take your trip with college friends. Yeah, it's good to have you on. Let's get right into it. I mean, the big thing that this year, and it seems like it's now been a theme for a few years, is the whole AI thing. And one of the things you and I were kind of talking about is how sometimes it kind of seems like that's been sucking all the air out of the room and no one can talk about anything else. But with this pullback, it became like, oh, is AI all that? Do we have to start looking elsewhere? What are you kind of looking at? How are you viewing AI and that whole rest of the market that is still there and still some great companies doing innovative things and with, let's face it, some cheaper valuations now?
That's it, Justin. You nailed it. We're always talking about NVIDIA. We're always talking about OpenAI, and just AI in general is the sexy supermodel on the runway that everybody's looking at. And by the way, there's still a zillion other companies that are very profitable, gushing cash flows out there that really just aren't getting the same level of attention. Right? We're
Hmm.
now at 40% of the S&P index is the top 10 constituents. That's incredibly high. A reminder that there are, by the way, 490 other tickers that they can buy in the S&P 500 that have got very profitable businesses too. And so I think that really, as an investor, you and I have talked about some real growth style companies on this show before. We've talked about Tesla, done
Yeah.
all right with Tesla in the past. We've talked about Rocket Lab. That's a 10 bagger since we last talked about it. But I think that I'm a little bit more cautious as an investor right now. I think that I'm really going to be more of a value hound here and encourage investors to look away from those top 10 positions, selling at those premium valuations. Find the value where others are not looking right now if you want to be a contrarian today.
Yeah. And I guess the hard part here is, um, if we kind of bring it back to sports, if you will, a lot of people are asking, okay, what inning are we in? For AI, there's a lot of the infrastructure that's getting laid down. There isn't so much the how are we making money from this thing? I mean, we know how NVIDIA is making money. They're just making chips left and right that everyone's using. We know that there's a lot of the infrastructure in terms of the folks that are cooling those chips because they run so hot and, the data centers and everything like that are needed. But you and I were kind of talking about how Facebook, when it came out with its IPO, Meta platforms, of course, now, um, you know, the monetizing part, has that part been figured out yet?
To the largest part, no. And I think that that's going to be one of the questions, as you look at AI, is this going to follow a similar trajectory as we've seen tech companies go in the past? If you looked at Google and you looked at Facebook, it's kind of similar tech companies that are perhaps similar to what OpenAI is doing today. They went after the users first. It
Hmm.
was, if you used to remember the Facebook IPO, we were talking about just before the show here, Justin, about how exciting it was when Facebook said, we're going to monetize with personalized advertisements on our platform. Before it was just to get as many people using it as possible. Same thing with Google for core search. And OpenAI now is coming up on 1 billion users. 1 billion daily active users are using GPT. And yet only 5% of them are actually paying for a paid subscription. About 50 million people are paying either $20 a month for the basic plan or $200 a month for the premium plan. And so you've got 950 million other users, which are basically, for the most part, not being monetized right now.
Hmm.
I think, Justin, that's going to transition in a lot of the same ways that Facebook did. You're going to start seeing advertisements placed within GPT and any of these other AI tools that are being used basically for free right now. For us, that's a benefit. We still get it for free, but you're going to be monetizing that user base in one way or another.
Yeah. Okay. So back to kind of the original question, what inning are we in? Is again, Facebook and Google, great examples of when they IPO'd, they were still kind of early in that monetizing, part of things, really getting the advertising. So where do you think we are in the AI cycle? Because again, you bring up a valid point. The valuations are very high here, but even like with something like Nvidia, for a while there, they were beating their estimates, and their earnings were coming in so great that despite the price gains that was happening in the stock, it was getting a lower PE, sometimes because they were that spectacular. So where do you think we are in that inning, or the trajectory, I guess?
So I'm going to go ahead and say the third inning, Justin, because it's definitely not the first inning. You've seen, I believe the number was $364 billion of capital expenditures between, it was four companies, Microsoft, Amazon, Alphabet, and I'm forgetting what the fourth one was, but it's basically the cloud titans. Maybe it
Hmm.
was the fourth one, but that's a lot of money, right? A third of $1 trillion is going into this, but then also looking forward, OpenAI in the deals it has announced has got another $1.5 trillion of AI infrastructure projects under development. Now the question is that legit? Or is that just something that's, you're really kind of taking a swing for the fences and all of those deals aren't actually going to happen? There's questions about, hey, OpenAI doesn't have that much money to commit to Oracle, to commit to NVIDIA, to commit to AMD. It's got some creative financing deals if you've been following what's going on in this space. But again, $1.5 trillion is a lot of money. It's certainly far from over. I don't think investors are ready to say, okay, we're throwing in the towel. This isn't going to happen anymore. It's kind of a wait and see approach because a lot of money's on the table.
Yeah. So, okay, Simon. So in the interim, while we're still kind of figuring out some of these things, as you mentioned, there's another 490 stocks out there, that are, some of these are real big cash cows, and they are, doing very well. They just are kind of flying under the radar. So what are you looking at to kind of get some of these on your radar and say, hey, these are worth a look?
Well, I think the first thing is you have to have a very profitable business, right? You don't want to go out there and it's just assume that everybody's going to benefit from this massive trend that's taking shape out there, right? There are going to be some losers that are going to lose share to the companies that deploy AI really well, and then those that don't are going to fall behind. So you have to say, first of all, is there a wiggle room for companies that are profitable to, if they give up some share, are they going under right away? Or is the balance sheet strong, profit margins very strong? You want to make sure you're getting into a business in the first place. And then secondly, are they innovative? Just as the culture of these companies, one that embraces AI and has shown that it's not going to get disrupted by others because it's going to stay a step ahead of these curves, or is it going to go the way of the horse and buggy, and fall behind those that do this better? And so when I'm looking, and then the third is, it's just a valuation, right? It's hard to make money when you're paying 50 times, sales for a company out there. It's just really hard to make money if you're at the top, like the Nvidias and the Teslas out there. Find me a company that's doing well, that is innovative, that is undervalued, and I think that's a pretty good investment to make for the next 5 years.
Hmm. And so remind folks that maybe aren't familiar with your stuff. And again, you do a lot of this with your service at Seven Investing, where again you're kicking the tires on the valuations. So what is it that you're looking at specifically? Because some would argue, well, the market's valuing it for what it's worth. It's looking at all these future earnings, the potential. It's putting this all in one area, and the market is voting, and it's valued at what it's worth. How do you look at things?
So, Justin, I'm going to go ahead and reveal my pick this month. You said, what do you do? Seven Investing is a stock picking service. We typically have the recommendations right behind the paywall, but today's recommendation, or this month's recommendation, reported this afternoon. And so I'm going to go
Hmm.
ahead and reveal it because we've got to talk about it. Salesforce. CRM is the ticker for this one. Salesforce is one of the world's greatest software companies. Probably needs no introduction, but this is kind of the pioneer of the cloud computing movement. The end of software, as Mark Benioff called it. Moving everything to centralized data centers, so you could access your software from any web browser instead of having these clunky on-premise or even CD-ROM deployments. It was a real big change 20 years ago when Salesforce did it, and they just got better and better as a business, right? They were kind of a centralized record for customers. They helped companies do their sales more efficiently, and then all of a sudden they'd layer on a marketing product to help out with that sales more efficiently. And then they'd have analytics, and then they'd have visualizations, and they go out and they acquire more and more companies, and all of a sudden your customers are saying, yeah, we might have been paying you $25 per seat per month for each employee before. We'll gladly pay you $35 per seat if you add on a couple more of these, bolt-on acquisitions and capabilities. And so Salesforce today has just become a massive business that's doing $40 billion a year, churning out 20% net margin, net profit margins out there, and even higher than that in the cash flows. And the thing that's very impressive is that they've done the acquisitions well. They do not fall behind because they're very good at acquiring companies that do what they want them to do and are also innovative and that can fold into the larger platform. And so Salesforce just reported this afternoon, third quarter results, beat on the expectations, raised the full year guidance again, Justin. But here's the thing is that it sees its stock as undervalued. And I don't want to give away the whole analysis on this, but I agree that I think the stock is about 40% undervalued right now. And so what does Salesforce do? It doesn't just say, hey, we're going to generate all this cash and just let it sit on the balance sheet. They come out and they say, hey, we beat expectations in the third quarter. We raised our full year guidance. We're gushing cash flows. We're going to put those to work for you, Mr. and Mrs. Shareholder, by buying back a boatload of stock. And so right now the company has said, we're going to raise our repurchase authorization from $20 billion to $50 billion. And so that's a pretty significant jump, first of all. But $50 billion, if they have deployed it all today, which they can't, this is going to take time. But just in theory, it would buy back 20% of the outstanding share count. That is absolutely massive to think about how large of a repurchase authorization that is for a company that's $250 billion and has become one of the most profitable companies on the planet during the last 20 years. Really impressive. Really impressed with Salesforce right now.
Yeah, and for a while there, it seemed like that was the buyback. It almost seemed like a scheme, right? It was like, oh, we have to get our earnings growth up, and beating, and it was almost like one of the ways in which, okay, if it's earnings per share, if we can change the share, if we can change the denominator, and kind of get that, through buybacks, it was inflating that EPS number. So it was a way to make your numbers, kind of thing. So do you think there's been a shift away from that? And now, again, you've got some of these companies that have a lot of cash and they're looking at, okay, we've made some very strategic acquisitions like CRM, and now we think that the best value is just in ourselves, because of what we expect the return on this investment to be, if you will.
Yeah, and looping back to what we said at the beginning of the program too, of this Salesforce is not a company that's growing 50% or 60% a year anymore, right? They're forecasting 9 to 10% kind of revenue growth, right? And call it 11 to 13% free cash flow growth, right? So it's not something that's just going to, everybody's going to just be impressed by this top line growth, but the expectations are so low right now with the stock price that even if they get their stated goal, which they've done very good, built credibility of when they make guidance, hitting that guidance. Here they are, they're coming out and they're saying, we're going to do $60 billion in annual revenue by 2030. And we're probably going to capture a 20% profit margin. I mean, if you just kind of forecast that forward, you come up with a stock price that is probably close to the range of $350, $360. And that's based on a combination of either discounted cash flow, which, Justin, that I like to get in the trenches and do the dirty work and, have my 5,000 spreadsheet tabs open for
I was just going to say, pull out a spreadsheet.
Whether you do that or you do the multiples, of where the stock might look, knowing that they're buying back so many shares. I mean, this is a stock that is deeply undervalued. You don't typically talk about a company that's $250 billion being intrinsically worth 40% more than it is right now. Mm-hmm. And I think that a lot of it is, they're still not being given the benefit of the doubt for AI. They launched Agentforce. They've got about 8% of their customer account that has already signed up for Agentforce. This is using AI to make sense of all the data that Salesforce has collected, and then actually autonomously making decisions off of it based on marketing, based on customer support, whatever you might want to do. Salesforce is showing people that it's actually doing this in its own business. It's repurposing 4,000 jobs in customer support that are going to sales now because it's going to use its own AI agents to do customer support. Mm-hmm. So it's working, and this is very profitable for businesses. I think it's going to stick. And I think that the stock is just completely undervalued right now.
Mm-hmm. So a lot of the stuff that you're saying, I mean, it's not like you have inside information here. You just, you look at the numbers, you make assessments, you come up with a thesis. And I will mention, I mean, you mentioned that the earnings growth is maybe a little lackluster, but I'm showing 23%, in terms of its annual earnings growth for the last 3 to 5 years. This is an earnings line I'm showing here on the chart. This green line, for those that are watching this on YouTube or on our channel, it's a pretty stable earnings growth that we have here. And 23% is no slouch, on an annualized basis. I mean, you give me a 23% raise each year, I'm going to be happy with that. Um, why is the stock not responding? Why is the stock just so out of favor? I mean, I'm looking at the relative strength line versus the S&P 500. It's dismal. It's still trading below its 40-week moving average line. Why why is there a disconnect from all these things that are pretty exciting as you lay them out on the fundamental side, but the market just doesn't seem like it's getting the buying?
That's what I'm saying, Justin. That's why it's my top stock idea right here. And just, I completely agree. Why not? I think there's some different theories on perhaps why, there's some caution about investing in Salesforce right now. I think that to some extent, there is going to be some cannibalization of this business, right? If you were selling software licenses for human beings, and all of a sudden you're replacing it with an AI agent that's going out and doing those things, I mean, you're going to kind of transition from bucket A to bucket B. It's great to see their AI division is growing 120% per year, but to some extent, that's just going to replace the subscription licenses it already has. And so that's why that's why I'm really looking at free cash flow generated, absolute free cash flow dollars generated, rather than necessarily profit margins or revenue line items as much. This is going to be something internal. And then secondly, the question is, are they going to be able to support those price points? Salesforce is not super cheap. They do have some lower priced options out there, but for the most part, this is, as the name would imply, a sales heavy, in-person sales organization. Our company is going to need to pay so much for Salesforce's products in the age of AI, or are there going to be nimbler, smaller companies that are going to accept lower margins just to try to get some of these deals? Maybe, but I think that Salesforce has shown us for 20 years that it's easier said than done to tear that stuff out and replace it.
Yeah, no, and I will just full disclosure, I've tried this stock so many times, and despite this huge run that it's had over the years, I just can't seem to make money on it. It's
Yep.
like I just never have the patience, to just kind of sit with it through some of these, normal corrections, or it just goes too slow for me. And it's so depressing to look at sometimes how much it's gone up, and I just haven't been able to make money on it. But I mean, it happens. I think that's more of a me problem than a CRM problem.
Here's your chance, Justin. By my numbers, I think that the stock is worth $938 by the year 2030, which would imply about a 32% compound annual growth rate for you for the next 5 years. Certainly worth a spot on your watch list, if nothing else.
Certainly. Yeah, again, as long as I can be patient with it, right? Let's shift over a little bit, because I think one of the big question marks out there has been kind of on this consumer discretionary side. On IBD Live today, I was pulling up our SPD, which is the equal weighted consumer discretionary. If we looked at XLY, which is the market cap weighted, this of course is dominated by Amazon and Tesla. Those are the two big, 40% of the ETF is those two stocks. But our SPD, the equal weighted, is showing some pretty good action here. And XRT, the retail ETF, that's back above its 50-day moving average line, kind of showing some signs of life here, relative strength that's getting a little stronger. There's been so many kind of back and forth theses here, in terms of what tariffs are going to do to the retail, and this is where I throw up my hands and say, politics aside, I just don't know. Like I'll say it's obvious after the fact, but in the weeds, I just don't know what the effect here is. But a lot of concerns about the economy, affordability, how well people are doing, what the tariffs have done. What's your take on consumer discretionary? Because this has seemed like an area that's been a little bit damaged, but there still seems like, look, we're a consumption society here. um, don't ever discount the American consumer, right?
Never underestimate the power of the American consumer to spend money. That is true. And I believe that the uptrend there, the optimism about the consumer sector, that probably started when the Erickson household started doing our Christmas shopping earlier
Yeah.
this week. So
Okay.
I
Perfect.
can understand what's going on with that.
Single-handedly turning things around for. Yeah,
Yes, it's
I'm with you. Sometimes I see all the Amazon boxes on our doorstep, and I'm like, hey, are we keeping you in business or what?
we're helping the top line, that's for sure.
Right.
I think all everything you said is correct, right? It's kind of a funky time for the consumer. The tariffs, are certainly not helping with that. The unemployment's been ticking up, not helping with that. Inflation's still around, never got down to the 2% we want it to. But I still think that retail's not going away. People are still going to buy Christmas gifts this year like they will the next year and the year after that. It's just that the market's perception of these stocks is much more pessimistic because of all the factors in the macro. And we've seen it in the numbers too, Justin. It's not like you haven't seen companies, whether it be Lululemon, whether it be Nike, whether it be Crocs, whether it be a lot of these other retailers, they're reporting negative comps year over
Hmm.
year, in North America. And you and I were chatting before the show too about the fast casual restaurants too, right? The Chipotle's and the Cavas have been suffering too because people just don't want to go out and spend $10 or $15 as often as they used to when we
Oh,
didn't
oh,
have
that's cute. $10 or $15. Yeah,
Sorry, I'm in Texas, not California, right?
okay.
Okay.
I'm like, where are you going out to eat? Because I shared that I went to Red Robin with my family the other day. The burgers were $20 each, and
Oh,
I'm like, what just happened? It was
you
sticker
got the
shock.
rest of your state moving to Texas, Justin. You might as well get on the bandwagon with this one, right?
I guess so. Yeah. So, well, I mean, and look, I was all on board with Cava. I thought this was very cool. And even before I ate there, I was like, oh yeah, this is um, you know this concept. I made money on Chipotle, and I was like, oh, I would love to do it again on Cava. And I mean, this earnings report right here at the top, it gapped up, looked like everything was great, and then finished really weak, and that was kind of it seemed like. So what's going on here?
So this is one I actually think that you can trade in and out of
Hmm.
and find the right point because it's a modelable, predictable business, right? It's not like Kava's gonna, one quarter have 100 customers that show up every minute, and the next quarter is going to have two. It's kind of you can see, how the business is going to look, and it's based upon the unit economics. The unit economics, I'm a fundamental analyst, at Seven Investing, but the unit economics are fantastic, right? 26% restaurant level operating margin. You got a 40% cash on cash payback period during the first year, and they're doing about $3.1 million in revenue per year. Those are really good. Those are almost in the same kind of range as Chipotle has done, even though Cava is a much younger business and it's still earlier in its growth cycle. But the numbers are good. Every time they're adding a new unit, they're profitable very quickly. They're churning out cash flows. There is an appetite, pun intended, for this company and its stock. I think that the question is, how much do you want to pay for that? Just like you show in the chart here, people were really getting excited about Cava last December. And the stock price was certainly showing that in terms of, how much were you paying in terms of market cap per existing location. It's very high, almost uninvestable at that time. And then we've seen that change around the strength index, like you're showing. People kind of said, hey, I'm out. I don't want to pay this much anymore when the economy is going through all the things that it's going for right now. But in terms of this business over the long term, I mean, Chipotle has proven that this concept works. Cava has already shown that it's working. The food's delicious. If you've ever been there, it's delicious. And I think it's going to be just fine, even in the tough economy of this year, which is kind of funky in so many ways, still producing really, really good unit economics. And now you're getting a pretty good price point on that too. I think that this would be a good one to buy and hold.
Now, I always feel like with these retail areas, the expansion is where it's really at. At least it seemed like that with Chipotle. I mean, it became, it was this one, a few restaurants in Colorado, if I'm not mistaken, and then all of a sudden it's like on every corner, it's almost next to every Starbucks. There's just that many. What does the expansion part of this do for your valuations and your thesis? Because again, the unit economics are one part, but it's kind of like when you start expanding and scaling, that's where it seems like sometimes the growth potential really lies. So how are you kind of how do you forecast that? How do you kind of look at that?
That's it. That's everything for these. That's the most important thing is how fast can you grow and how fast can you scale, right? That's the one that separates the best performers from the ones that don't quite make it out there, right?
Hmm.
Just in terms of um, these are rounded numbers, but over the last decade, Chipotle stock has been a 100 bagger. Starbucks in 3 decades has been a 300 bagger, and McDonald's has been more than a 10,000 bagger, 10,000 times your initial investment since it went public 60 years ago. Why? Why did those companies? I mean, that's fantastic. 10,000 bagger. I mean, you buy one share of McDonald's 6 decades ago, and now your entire family is doing just fine.
Right.
But it's all about, are you controlling the entire experience? Are these company owned or are they franchised? Where are the locations? How big can you get? How many can you support in an area? I mean, there are reasons that um, Cava, for one, went out and bought Zoe's Kitchen, which was
Hmm.
similar Mediterranean concept, but the stores just weren't cutting it. They couldn't get people through the line quickly enough. They didn't have the right menu and all other things. And then Cava comes in and says, no, we need to do this like Chipotle did. You want to get that line moving as quickly as possible. You need an app where people can place orders. Basically, efficiency is everything. And that's what they did and just kind of revitalized the entire brand. And by the way, they bought Zoe's Kitchen for a fantastic deal a couple of years ago. But the expansion, I think they're right at around 400 restaurants today, have 400 or
Hmm.
so. And I think that they've said publicly they were looking to get to 1,000, which would be, 2.5 times their existing footprint. And then there are other, kind of external analysts that said that it could be closer to 2,000 probably. It's doing very well. I don't think by any means they're anywhere near saturated, especially in the Western states. They're a little
Yeah.
bit bigger in DC, in the areas of the Northeast where they were first located. But I think there's still plenty of expansion for Cava.
Hmm. Now, you also brought up Lulu, so just kind of sticking with the retail space, this is very different. I mean, Lululemon has been out there for a while now. It's not like a Cava, so this might not have the same kind of expansion, I guess. So, what gets your attention on, I guess, let's call it a more mature business? And it's certainly had its runs of popularity and I'll be honest, we just did a little Lululemon trip ourselves for my mother-in-law and my wife, buying some things. Um, so it's not like it's out of fashion. The store was still it was almost like going to a bar with a bouncer. There was this young woman at the front, and hey, our store is just too packed right now. We've got a we've got a rope here, and when people come out, we'll let you in. But definitely a more mature business here. So does that change your thesis at all?
Lululemon is an interesting one. This is one that is going to be talked about in business schools because it's got some problems it needs to fix. This is not just a do the exact same thing and everything's going to be fine. Lulu's got some issues. Um, what it tried to do was expand beyond yoga into more of a lifestyle brand. It wanted to
Hmm.
be a lot of things to a lot of people, not just a yoga enthusiast that already love the products and were willing to pay top dollar for them. And what they did is they launched way too many products, too many product lines. Some of them worked, most of them didn't. They had too complex of a supply chain, and all of a sudden, these new ideas that were being pitched in marketing conversations behind closed doors. And once they got out there to the market, they didn't perform as they were expecting to, and they were too slow to close them down. And so Lululemon, you saw the decline in same store sales. I believe it was down, was it 2 or 3 percentage points in North America comps year over year? It's got to pull back and be a more streamlined organization. It's gotten too complex, especially with the tariffs and the supply chain challenges that we've seen this year. But still, I mean, are the pieces there for an investing thesis in Lululemon? I think so. I mean, the average sales per square foot of all retailers in aggregate in the United States last year was $325 of revenue per square foot per location of retailers.
Hmm.
Lululemon's were $1,574, right? 5 times higher than the average retailer for one that has physical stores in America. And then their operating margins, 22%. I mean, that's a lot better than Nike, which was negative 8% last year, and Under Armour negative 2%. I mean, this is a very profitable business still. But it's got some things it's got to work out. I think that it tried to grow too quickly. And now you saw its longtime founder kind of going out there in the Wall Street Journal and saying, hey, we've got some cultural problems we've got to fix at the top. These are problems that I think are fixable. They take some work, but it doesn't mean that the brand is doomed. It doesn't mean that the business is doomed. And I think that that is kind of the turnaround story. If you believe in turnaround stories that actually can happen, Lulu is a compelling one right now.
Hmm. And I guess a lot of times this kind of comes back to what you said. It's how quickly can you recognize when you're doing something that's not working and pivot from that. I guess what gives you that confidence in the management? You know, I mean, how well do you have to know the management and kind of build that trust that yeah, they made mistakes in the past, but they're not doomed to repeat them or continue making different mistakes. They've learned their lesson. How do you kind of get that confidence in management?
They haven't given us credibility or confidence yet. They've been messing this up, to be
Mhm.
honest. But they did address this on the most recent conference call. They said, look, we're going to try out trial markets for new brands, kind of these mini tests, these beta tests, if you will, of new styles. And then if the initial ones look good, then they'll kind of roll it out to the larger scale and then kind of go nationally with them if they actually do work out. I don't think they did a good job with that. I think that they were just like, oh yeah, hey, we're going to do this. We're going to immediately gain the economies of scale from something like this, and it just didn't work in the first place. So I think they're being a little bit more measured. At least they're telling their investors they're going to do that, when they're speaking publicly about it.
Yeah, no, makes sense. You mentioned Nike a little bit and the struggles that have gone on there. Let's go with another, I guess athletic shoe, Crocs, because nothing says athleticism like when I'm wearing
I
my
was wondering
Crocs.
if that was an athletic. Okay, I'll give you that, Justin. Okay, you can swim in them. You can get in the pool
Right,
with the Crocs, right?
exactly. But again, a mature business. I mean, it's always tough with shoe companies. We have so many examples of these in model books, like whether it was Reeboks and LA Gear back in the '80s with the aerobics craze, or on shoes, the Deckers with Uggs and Hokas. There's always kind of this faddish part, and Crocs definitely had that too. Look, my girls, they hate the fact that I still have pictures of them in Crocs, and they had the little things to stick in them and everything like that. But they were big Crocs fans back before they got fashionably conscious. So with Crocs, what is it that's kind of turning this on your radar recently? And by the way, I should mention Crocs was left for dead after 2008, and this was one of the biggest surprises to me in terms of a comeback. Especially it seems like after COVID, where it was like Crocs became like chic again, and they were doing deals with all of these celebrities and stuff. So what's next for Crocs in your mind?
Well, before I get into that, do you own a pair of Crocs, Justin?
I do, yes.
And where did you buy them? Did you buy them from a shoe store, in person, or did you order them online, or how did you buy it?
Um, it my Crocs are 15 years old probably,
Okay.
so I I don't know. I mean, this is back when and mine are actual Crocs, but I remember Big Five having the knockoff Crocs,
There you
all
go.
of a sudden in 2008, but maybe they were a gift. I don't know, but I have them right here if you want to see them.
I won't hold you to it to remember. The question is intended to show that this is a company that moved from being, just selling at physical locations and having too many stores to moving it online. And
Yeah.
then, now all of a sudden you can buy it's easily memorable Crocs, everybody remembers the name and the brand.
Mhm.
You just go online, you customize it however you want to. I used to put New Orleans Saints, logos everywhere, and now we've had a terrible season, so I refuse, just kidding, But you can, I mean, they've got they've partnered with DC Comics, and, basketball teams, but you can basically get any kind of Crocs that you want out there, and it's totally customizable when it ships right to your door, which makes
Mhm.
it simple for people that love the brand to get this more efficiently and quickly, rather than having to go out and make a trip to the Crocs store to buy
Yeah.
Crocs. And it's the same reason that Build-A-Bear, if you remember Build-A-Bear, BBW, if you want to look at that
Yeah.
stock chart, it's the same exact thing. Build-A-Bear used to just be the kiosk in the mall. Look at the stock going from, what was it, $1.50, $2 to $60 within the last 5 years. I mean, this is something that embrace the internet and the customization potential of something that's simply just a plastic shoe that you can now charge $50, $60 for and get very, very high margins.
Mhm.
And I think that this is really interesting because Crocs is not a fast growing brand. It's just another retail that most years is going to grow at 3 to 5% a year, right there along with GDP, but fantastic margins, 22% operating margins, fantastic profitability, 27% return on invested capital, and 57% return on equity. I mean, this is a company that just generates a ton of cash and doesn't have anything they really need to spend it on.
Mhm.
And so what they've done is they've become a stock cannibal. They have bought back, eaten back, their entire company a little bit more every year and just repurchase shares so aggressively so
Mhm.
that every time you report earnings per share, there's a lower denominator, right? It's lower lower share count every single year. So now all of a sudden the numbers you're reporting are getting 10% higher, 15% higher because of these buybacks. And this almost jumps off the page to me. I mean, I almost can't believe this. They have a 15% free cash flow yield right now, which translates into just over about 6%. Um, I'm sorry, less than 6 times free cash flow is what the stock is selling for right now. That is cheap. That is cheap, 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 cheap. Crocs is one of the cheapest stocks with the highest profitability in the market. Yes, it's just plastic shoes, but my goodness, it's done all right for itself, and it's buying back a ton of its stock today.
Hmm. Well, okay, so now in light of the fact that it's doing these buybacks and again changing that denominator, it still can't seem to get the growth numbers. I mean, the last 4 quarters negative growth. So I guess despite that, does that give you a concern that it's still? I mean, look, having the status quo isn't bad, if you're kind of because again these numbers are, it's not like it's losing money, it's still making money, it's just not growing at the rate it was, and it's a little bit of negative growth. So I guess how do you kind of square that circle if you're doing that to the denominator and you're still got got some negative numbers there?
So they made a terrible acquisition back in 2022 of a company called Hey Dude. This was supposed to be kind of a really comfortable, Italian shoe. They thought it was going to catch on with the younger generation. Didn't work.
Hmm.
Immediately, people going viral talking about how they felt like Kleenex boxes on their feet. And if you know that there's a kiss of death in retail, it's having the younger generation publishing TikTok videos
Right.
about your company. Bad news, right? They're trying to reinvigorate Hey Dude, which I believe was down something like 20% year over year in sales. Just weren't selling at all, especially in the wholesale channel, to the shoe stores and local bricks and mortar retailers and things like that. Just nobody was buying them. They've hired Sydney Sweeney, very popular American actress to be the marketing ambassador here. They hired the guy from Stanley Cups, the giant cups that everybody loves. He's going to come
Okay.
in. Terrence
Hmm.
Riley, I think was his name, is the chief brand officer. They're trying to reinvigorate reinvigorate Hey Dude, but this has been a giant anchor on the company. About 20% of sales and getting lower every year as it becomes more and more irrelevant. Justin, they took an impairment charge this last quarter. Voluntarily wrote down the goodwill of that acquisition, which was $2.5 billion back in 2022. Really lit shareholder capital on fire with that. And I think that it's kind of a mea culpa now. Hey, we're sorry. We didn't mean to do that. We're still a good business out here. But I think rightfully so. Investors have still punished them for a bad capital allocation move 3 years ago, which is still pulling down the top line growth for sure.
Hmm. And I should also, while I did kind of give a lot of flack to them for those negative numbers, I should still point out that the annualized number here is still pretty impressive, 31%. So while the most recent quarters have not been that great, it still has a very impressive annual growth rate. 31%. Not the stability that we saw from CRM, and it's certainly flattening out here, but. 31% is no slouch.
Yeah, and
Um,
one more thing, if I may, just that you look
yeah.
at the market cap on their $4.6 billion market cap, they've got about $1 billion authorized for repurchases. We kind of introduced this segment talking about companies
Hmm.
using free cash flow that they're generating tons of to buy back their own stock. This is the highest share repurchase authorization that Crocs has ever had. That would buy back about, a little bit more than 20% of the shares here today. And again, if you look at AutoZone, I believe it's AZO, ticker for that one, another company that's just kind of grown very slowly.
Oh,
Not as maybe AZO. Yeah, we go.
yeah. Sorry.
I mean, look at the long-term stock chart on this one. Another company that just has relentlessly bought back shares to boost its earnings per share over decades. Growing at GDP growth. This is not a company. AutoZone's buying, auto parts.
Hmm.
Retail. This is simple. This is a 3 to 5% growth business that just put every dollar that it generated into buying back its own stock. One of the market's best performers over the past decade.
Yeah, and I'll go ahead and show the monthly chart on this. A lot of, I bring this, surprisingly, I bring this stock up a lot because Bill O'Neill, the founder of Investors Business Daily, got this in 2010, and it was one of those stocks that, you had all of these stocks bouncing back in 2009 after the great financial crisis. And so you had, things like Ford and Bank of America that went from, a dollar, $2 to $10. And it was like, look, you got a five bagger right there.
Yep.
Just kind of coming back. But AutoZone really didn't participate in that part. They were like a year later, they had this phenomenal move, and the relative strength was really poor. I think it was 29 when Bill O'Neill bought it, and it was very unusual for him to buy a relative strength that low. But it was again something out of favor that was a little bit of it was kind of its chance to shine in the sun, if you will. So, Simon, I feel like you're bringing up a lot of these, kind of that theme, but it had a great business. And it should also be mentioned that you had a really rough economy still in 2010. And this does, when people start thinking about, oh, instead of going out and buying a new car, I want to slap some band-aids on my old one. AutoZone and O'Reilly, I mean, those are who you think of, and certainly that can help when the economy is a little bit tougher. So yeah, no, very very interesting there. I want to kind of finish out because one of the things that you and I were talking about as well was the prediction markets, and a few months ago I had the chief brokerage officer from Robinhood on. He was talking about the prediction markets business, and basically there was this tax code change to how gambling losses and gains offsetting how those were treated, and it was just Scott St. Clair, one of my colleagues, was like, this doesn't make gambling fun anymore. When like when it's one thing to have the house stacked against you, but it's another thing when you are also having the government and the IRS and everyone piling on stacked against you. That's even tougher. But prediction markets, it's a futures contract, so you get 60% long-term capital gains for these. So DraftKings, of course, a big player in the sports betting, and phenomenal run here. A few years ago, a lot of people were concerned that after that tax code change and prediction markets coming out that it was gonna eat their lunch. But I guess it's one of those, if you can't beat them, join them, situations. So yeah, what do you think about this whole area, and how are you thinking of this in terms of valuations?
Yeah, it's an interesting one because it kind of, morphed from these kind of, these daily little, kind of side pot things that you would do, daily fantasy, they called them,
Hmm.
where they weren't really wagering, but they were actually paying out real money to participants, right? And then that kind of evolved into, okay, now we can be a sports book, and we would get regulated on a state by state basis, just kind of in the same way that Harrah's and Caesar's Palace and the Bellagio were being regulated by the state of Nevada. You would have FanDuel and DraftKings become an oligopoly, right? Basically, a two-horse race, 80% of the market share in terms of online sports books. You can do this through the app in the states where they were legal. I could not in Texas because Texas did not allow online sports gambling. And so there was kind of this eternal struggle with the regulators and, like you said, the tax codes and how states wanted to regulate all these things. And they had to do it on a state by state basis, and it just was hard to scale, and that's why you had two at the top. And so DraftKings and FanDuel took the lion's share of the profits of what this industry was. And now this has completely flipped the scripts. You mentioned that prediction markets are a financial product. This is not an online wager that like you would be doing at a casino. And so it is regulated completely differently. This is now also taking out to step back on this. You used to be kind of gambling against the house, right? When I would go and I'd place a bet on how bad the Saints were going to lose this next game for football, my odds were created by DraftKings, and they would always kind of be in their favor, right? I didn't really know
Hmm.
what the true odds were, but I wasn't getting 50-50 on all the bets. They were always keeping a little bit more.
That's
And
the way casinos work, right? You know,
and it's weird
the
because
model.
when you would see DraftKings report earnings, they'd say, oh, there were more player friendly outcomes. That's their way of saying, hey, the people that logged into our app won. They made the
Yeah.
right bets. We didn't
Yes.
report as good of earnings because they won. Our users did good.
Yeah.
But it was strange. It was always kind of like this back and forth. And so prediction markets are just the opposite, where this is actually kind of a consensus where, it is people betting on one side of betting A versus betting B. And the true odds, somewhere can be anywhere between 0 and 100. and you've got the prediction markets, the poly markets of the world, the Kalshis of the world, whatever it might be, taking the cut in the middle, like you would see from a brokerage platform, something similar like that, rather than betting against the house. And so it's immediately available everywhere, Justin. To your point originally, yeah, I mean, this is going to expand the market for the incumbent players, the DraftKings and the FanDuels, but there's also going to be a lot more competition because now anybody can do this. It's available in all 50 states plus DC.
Hmm. So is there, I guess, is there some of this first mover advantage? Again, I think Robinhood was very early. Oh, I hit the wrong button there. So yeah, I think Robinhood was very early on in terms of kind of putting this into their brokerage model, which again scared some people with. Hey, is this something we really want to have in our brokerage accounts? Sports betting, that's something we'll leave for another day. But is there a first mover advantage here? And DraftKings, are they catching up? And how do you kind of, I guess, win at the game at the end of the day?
I think there's a first mover advantage for online sports betting. I think for the most part, just the rule of it's easier to not install a new app versus just keep the one you're already using is going to
Yeah.
go into effect here. If you've been using DraftKings and it's working fine for you, probably still using it. I don't think there's going to be a whole lot of loss of market share of the existing customers they have. But I also think this is opening up a lot of new things that we haven't been doing before. You can bet on anything now,
Yeah,
Justin.
right. Yeah.
Like, I'm not even kidding. Kalshi allowed you to bet on presidential election outcomes, and now it's got prediction markets. You can bet for how many times President Trump is going to say the word tariff in his public, speeches.
Uh,
You can bet on how many times we're going to say AI in this conversation. It's like, there is a consensus you can create for almost anything out there that people want to bet on. And now people are glued to their phones kind of saying, I want to bet $100 here on this. I want to bet $200 on this. Prediction markets is allowing that to happen. It's more interesting than just the gambling aspect of this. So this is now kind of showing the consensus
yeah.
of public opinion. Do people think that this trade tariff policy is going to go through? Yes or no? What is the public saying on poly market right now? I mean, when you hear the founders of these companies, who are already billionaires, by the way, they're kind of referring to this as not just an online casino that's more efficient because you're not playing against the house now anymore. This is kind of like insight to how the American public feels about a variety of things.
Hmm. Yeah. Now, like with the most recent presidential election, I remember that there was kind of a lot of talk about this whale that was skewing some of that, right? Because again, it's an equilibrium thing. It's not the House saying, "Oh, here's where we're going to put the line." It's, "Oh, okay, we're coming up with this equilibrium in the poly markets from buying and selling and everything like that." Do you think that there's, I guess, what's some of that downside risk here on the poly markets? Is it um, areas for distortions or um, just those unintended consequences? I guess.
Yeah, I mean, consumer financial protection is a hot thing, right? You don't want to go out there and let people bet on everything, and then all of a sudden nobody can pay their mortgage anymore because they gambled on everything that was not, wasn't regulated. They weren't actually making sure it was fair bets, and it was.
Mhm.
There's certainly a regulatory piece of this, but again, these are financial products, so it is certainly easier to do things like this, and it's universally available. Maybe this isn't the right investment for everybody. Do you want to encourage more gambling at a national level? Is it good that people are now all of a sudden tied to their phones and making bets on everything all the time? I mean, maybe not. The markets are going to do their thing out there, but it's not a investment without risk. But I do think that companies like DraftKings, which were previously a little bit more isolated and siloed into the states where they're operating,
Yeah.
and then that even had kind of its own risks. What kind of tax rates are they going to have to pay to the states, and are they going to raise those over time? I mean, that's kind of all um, a little bit less relevant now, as
Hmm.
these are financial products and universally available, and a little bit more clearer boundaries of what is and what isn't permitted. I think it's certainly interesting to see what's going to happen with this going forward.
Yeah. No, it's a double whammy, right? As you said, it's regulatory easier and a market opening up for you with more states, and that combination. It's hard to see how it doesn't work out well
Yeah,
for them.
and it's
Uh,
ultimately scalable. I mean, talk
yeah.
about operating leverage. I mean, you literally build the platform and you just let it loose.
Mhm.
Minimal reinvestment required for this. More volume, more rake that you take. Incredible how quickly you can boost operating margins if you get the volumes on these platforms.
Yeah, no. Well, hey, Simon, again, it's always so interesting. I really appreciate how much research you put into everything and, all these numbers that you do. As you said, I guess you're a little bit of an insomniac, so you must not sleep. You're just reading, about these companies and, doing your spreadsheets. Okay, perfect. And also, I want to make sure that people know where they can find out more information from you. You are on X, right? So if you could go ahead and give us your handle again.
Yep. So at 7innovator is my
Hmm.
X handle, and
Okay.
7investing.com is the website.
Yeah.
We make stock market recommendations on the first of every month, and then in the middle of the month, put out our 5 best buys in the market. So
Hmm.
that's coming up here, next week, Justin. Looking forward to giving some new investing ideas out there for individual investors.
And just so people understand, what is kind of the time frame of your ideas? Like you told me, hey, this is something you can hold on to Cava until 2030 and or a decade. What's kind of your typical time frame that you're looking at for
Always
the
three
thesis?
three plus years. Yeah, it's always going to be a 3-year time horizon. So that can be stocks that are out of favor right now, like we discussed Salesforce, we discussed Crocs earlier in the program, but it can also just be a mispricing of a growth opportunity. Rocket Lab was a quintessential 10 bagger that was on the scorecard not that long ago, completely mispriced by the market. A lot of it is kind of the balance between misunderstood growth and completely out of favor value.
Mhm. No. Well, again, Simon, thank you so much for being on. Always great talking to you. Really appreciate it.
Thanks again for having me, Justin. It was a real pleasure to be here.
Absolutely. That's going to wrap it up for us this week. Thank you so much for watching. And next week, we've got an old favorite coming on again, Jeffrey Hirsch from the Stock Traders Almanac. He's the editor over there. He's going to kind of give us his thoughts. He's got the 2026 Almanac out, so we'll learn a little bit about what he put in there and what his outlook is for the year. So hope you join us for that. Thanks a lot for watching. We'll see you next time.